Hello, chart watchers, and welcome to this Tuesday, January 15th, 2019 Market Watchers Live Show with your host, Tom Boley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, as we look at the market today, JP Morgan came out, thought maybe they would put a little, maybe a little bit of a curveball, throw a curveball at the market, but doesn't seem to be slowing the market down at this point. We got the Dow Jones Industrial Average currently up 143 points. The S&P 500 breaking above 2600, trading at 2608 right now, high of the day, up 26 points, roughly 1%. The NASDAQ up 108 points, also trading to a new recent high. Russell 2000, like yesterday, lagging a little bit on a relative basis, maybe a slight warning sign, but the Russell 2000 is higher, up about 0.5% today. 10-year Treasury yield rising off of earlier lows, same as yesterday. It is up now about a basis point, 2.72%. Volatility continues to take a move to the downside. It is down 4.3% today, getting close to 18. Healthcare leading to the upside today, up, probably about 1.5% or so. You got the internet group, another very, very strong area of the market. You can see breaking out and not too far from its early December high. Really good action here on internet. We'll talk about that area and show some other charts here in a bit. United Health came out with their earnings. This is one of the reasons why healthcare is performing so well. You can see United Health getting a very nice response to its earnings. Netflix continuing its huge surge off of that December 26th low, up another $22 today and helping that internet space. A couple of laggards though today. PCG, which is PG&E, been under a lot of pressure. Yesterday we talked about the bankruptcy filing, the Chapter 11 that the company had announced, and it continues moving lower. Yesterday it fell 52%. Today it's down another 17%. And then Sherwin-Williams came out with a warning, and the stock down $15 to $382. Well, Erin, we got the market showing incredible resiliency in what certainly appears to be a bear market, but tell that to the bulls here the last 2 or 3 weeks.
Sure, but we have to have upside some of the time too, and I think this is some opportunity. I'm not in at this point pretty much, but I think this might be an opportunity if you are still in to kind of look at what you've got, because this could be an opportunity. Although I must say, and you haven't said it yet, we are above 2,600 now on the S&P 500, and that kind of was my point of where I was expecting some weakness and a failure, but apparently not.
Well, we could still leave a tail up above that 2,600 and finish below it. If there's any chance of it happening, it probably increased significantly when I got stopped out of my shorts earlier today.
Of course, that's why the market's up, Tom.
Well, no, I got stopped out. So now that would be a good reason for a reversal at this point.
Got it. Yes.
I'd love to see it keep going up this point. And actually, I think it's got a shot now to go to that 20-week moving average, but I'll pull that chart up in just a bit. But I know we got a ton going on today, including my workshop. So I'm going to let you take it away.
Absolutely. All right, our upcoming schedule for the rest of the week. Tomorrow we have David Keller, the Mindful Investor. He will be joining us. On Thursday, Mr. RRG, Julius de Kempener, will be joining us from the Netherlands. And then on Friday, we have What's Hot, What's Not with Mary Ellen McGonigal. And then Monday is Martin Luther King Jr. Day. So Stock Charts won't be doing any live shows on Monday, but we'll see you Tuesday after the holiday. All right, today, as Tom said, we're going to start off with his workshop. He's going to show us how to identify tops and bottoms. And then for 10 and 10, our first symbol is going to be Amarin Corp, AEE. And then we'll finish up. I'll do a scooter report. We could check and see what is going on with StockCharts Technical Ranks in the sectors and industry groups. All right, let's go ahead and get started, Tom. Technical news and headlines.
Okay, well, first let's get into the economic reports. We did have the December PPI out this morning. It fell 0.2%. Market was expecting a flat reading. The core PPI fell 0.1%, but the market was actually expecting a rise of 0.2%. So I would say inflation at the producer level, not a problem, at least based on today's reports. the January Empire State Manufacturing Survey came in. This was a little bit of surprise. Came in at 3.9 versus 12 expected. So it is showing a little bit of a slowdown, kind of following along with what the market was telling us back in December. And that did cut into gains in the futures this morning. And I thought maybe that, along with what we heard from JP Morgan, maybe that would be enough to take the market down and maybe see that 10-year Treasury yield dropping as well. But let's take a look at that yield based on the economic news out. And you can see that although it was down earlier, we have rallied back, currently at 2.72%. And one thing that's interesting about this chart off of the low at the beginning of the year is to notice all of these hollow candles. Anytime you see the yield continuing to rise throughout the day like this, it means that treasuries are selling off throughout the day. And this is one of the things that's helping to fuel the rise in the equity market right now. So even though we had weak economic data out today, and we were lower earlier, you can see money rotating actually away from treasuries, sending the yield higher today. And that money is clearly rotating into equities. So what's typically good for the yield to the upside is also typically good for equities to the upside. Now, question becomes, can the 10-year Treasury yield clear what I think is rather significant overhead resistance now at around 2.75%? That's exactly where the 20-day stands. And if you look at the two of the key lows in 2018, we saw 2.77%, 2.73% on the close. So this is an area of overhead congestion. We did hit 275, failed, moved back down. Now we're rallying again. As we get up into this area, it's very possible that the money rotating away from treasuries continues to push equities higher, and that could result in a very significant 20-week EMA test, which I think is going to be like the final line in the sand for the bears. If you're looking for this market to roll over, I think it probably needs to happen by that level. But we'll be talking about that not just today, but in future days and weeks ahead. All right, as far as the earnings reports, we are beginning to kick into earnings season. JP Morgan, 198 versus 220. And in addition, Jamie Dimon, their CEO, came out and had some not so great comments about the government shutdown and indicating that if it continues, it could really have a major impact on the GDP and, of course, bank earnings and so forth as we go forward. So I thought the combination, and by the way, JP Morgan did fall short of their revenues, just like Citigroup did yesterday. So it really wasn't a very good report by JP Morgan, but we're going to look at their chart. They're actually bouncing pretty nicely off of a bad report, and that is a pretty bullish sign. So a lot of mixed signals in the market right now. United Health, you can see beat. Wells Fargo, Delta Airlines, IHS Markit, all beat on their bottom lines. So really it was just JP Morgan that was the outlier this morning. Tonight after the bell, we will get United, and that'll be an interesting report because Delta Airlines reported pretty good bottom line numbers, but top line numbers I think came in a little short, but we'll talk about that in just a second. First, let's pull up JP Morgan's chart. And here, this was a gap down that we saw earlier today, and you can see the recent lows in 2019 have been right at about this 98.5 area. We opened today 98.89, got as low as 98.60, kind of like yesterday's low. And look at this breaking out to new highs. So again, this to me is a bullish development when you've got stocks that obviously were broken. We got a rally, got the bad news that we were expecting, but instead of the market rolling over, instead of JP Morgan rolling over and heading lower, we're seeing a lot more buyers coming in. And the volume today, 14.5 million shares. We're not to the halfway point of the day. This, I think this candle we're going to want to watch. If it continues to move higher, this really hollow, big, long, hollow candle with heavy volume reeks of accumulation to me. So we want to kind of watch this area. And if you go back and look at JP Morgan, a lot of support between this 102 and 104 area. Throughout 2018. We lost that on big volume in December, and here we are moving back into that 102, 104 area. So if you're looking for a key area for JP Morgan to reverse, I would say this is it, especially with that 50-day moving average coming in there as well. On a relative basis, you can see obviously the banks have been performing poorly. JP Morgan on a relative basis has been one of the better performers Not so much during the rally here. Banks have been rallying. You can see we pulled back. But throughout the downtrend, JP Morgan was not hit nearly as hard as the overall bank group. So versus the S&P 500, it's been kind of a crapshoot over the last year with JP Morgan, but at least amongst its peers, it does still have an uptrend in play. All right, let's move on and take a look at United Health. And with United Health, you can see here is the big move. But once again, if you take a look back, 255 has been a big area. Currently, we're at 256 and change. Can we sustain it? I don't know. Big volume down, taking out that support level. Now we're testing the resistance from underneath. I'm not going to go through all of these charts that we had today in terms of the earnings, because I do want to show you a couple of other charts. One, healthcare leading the market today. So let me go ahead and actually just go to a regular daily chart. And you can see it breaking out. So you got a nice little move up, a little flag, and we're breaking out above it. So on the daily chart, I would say things look pretty good. But what we're seeing a lot of is the weekly charts now. We're getting major tests. We had a breakdown on the XLV. You can see that the PPO went slightly negative. Even with the rally of the last 3 weeks, that PPO is not bouncing. And we are testing that 20-week from underneath. So a failure here, we could see XLV turn right back down to the downside. Let's take a look at the internet stocks. I mentioned earlier they're having a fantastic day today. Making big breakout. This is the highest level we've seen since the beginning of December, but there is a lot of overhead resistance around that 1550 level, and we're getting close. And perhaps more importantly, again, the weekly charts. So daily looks good. Look at the weekly coming up. We have failed over the last 4 months at that 20-week moving average, have not been able to get through. We're currently 4 points above it. So this is an area where you might keep an eye out for a possible reversal. One last stock I wanted to mention today. I happened to see it was performing well, and just wanted to remind everyone, I think we talked about this one on the show. I know I had it in my blog, but Insight Corp making a huge breakout to the upside. Big volume, making another breakout of this little flag pattern. Things look great. This was one that was discussed as one of the best seasonal charts as you head into January. If we pull this up and go back over the last 20 years, Insight, 8.8% average return over the last 20 years in the month of January. And so as we go back and now take a look at that chart, you can see that as it was going into January, the stock was trading at about 63 and change. It is now at 78. It's up 20% so far in the month of January, so it is following its seasonal pattern. All right, Erin, a number of upgrades, downgrades. I'll turn it over to you.
All righty, let's take a look. All righty. Let's see what I wanted to show you, if I can get there. Here we go. All right, so let's go ahead and we'll start with those upgrades and downgrades. So the first one I'm going to show you right now is Akamai. Akamai was upgraded today from equal weight to overweight. I took a look at the chart. What I noticed most was the double bottom that it is coming in off of this decline. If you do the measurement, this is the confirmation line for the double bottom. And so once you get the breakout above it, and to me, a hold of that confirmation line, I want to see the price hold above that. And that's what we're getting. So if you do the measurement, we should actually get up to right around where this gap was. You can see 68 is what I'm looking at, $68. But I'm looking also at where the next level of resistance is. And really, yeah, the 68 level is going to be very important. So something to keep an eye on. And of course, PMO is on a buy signal. So I think this was a, a thumbs up upgrade. Let's skip Citigroup, probably benefiting from what's going on with JP Morgan, I guess. BMO Capital upgraded Citibank from market perform to outperform. I think it's a good day right now for most of the financials, and seeing this breakout just above support here at that really the lows that we've seen back here in November. That's where I'm really looking. We've got the PMO buy signal, but Citigroup has been doing quite well since the end of December. It's really been performing well, and it's on a really nice streak with this V bottom. But we really need to get that breakout, and we need to hold that area of support. At this point, I think you'd be chasing it. So we do kind of have to wait here, see if we get the breakout, in which case we have a nice trading range here between $62.50 and $75. All right, Helmerich and Payne. There we go. HP was upgraded today by JP Morgan, neutral to overweight. What I would point out on this chart is the flag formation that I see at the end of this rally. We're getting that nice little flag, and that's a bullish pattern. We do have the 50 well below the 200, and price is below the 50-day EMA right now. So we have to be careful about our expectations as far as this flag executing. But so far, things are looking pretty good, and we have an oversold PMO buy signal with a strong PMO. Notice that it's not really decelerating, even though we're having price move sideways now for almost a week. So I think that one looks pretty good. Medtronic was upgraded today by BTIG Research from a neutral to a buy. And as you can see, we bounced right off of support at $82. That matches up very nicely with that June low, some of these lows back in May, and of course the top of the trading range between February and May, also where that lines up for us as far as support. So not a surprise to see the bounce off of that, but where's our next area of concern or resistance? I would say at the low back here from October. So $88, I think we'll manage to get up there. And honestly, if the PMO continues to move higher and close to that PMO buy signal, I think we could see with the breakout a run up to $94. So I think that Medtronic's looking pretty good. It's in the healthcare space, which should do well if the market in general isn't, which is what I suspect will happen. All right, race, Ferrari. Ferrari was upgraded by Bernstein today from an underperform to a market perform. Kind of a lukewarm upgrade, but a nice flag also forming here. You can also see that even though price is moving sideways, the PMO is still rising strongly, which suggests to me that we will get the breakout and an execution of this flag formation, which is a bullish pattern, as I said before. So if we get the breakout above the flag, here you can see the flag portion right here in the thumbnail. If we get that breakout above that, that actually will execute the pattern. But personally, I would want to see a move past 115 because the flag could fail. The 50 is below the 200. While this looks pretty good and the PMO looks quite healthy, again, you have to just temper your expectations just a wee bit. All right, let's go on to our downgrades. CIBC, let's see, downgraded Newmont Mining from a sector outperform to a neutral. We have a really bad break of a rising bottoms trend line. And this trend has been really in place since the bottom back here in September, and we've continued rising. We did have a test here back in October. We fell lower, but we didn't get below the low from September, and we bounced back. But in general, this rising bottoms trend line is, pretty strong and important in my opinion. And we ended up with a failure yesterday, and now we're dropping even further, over 2%, looking at $31 now for support, which could certainly hold. It does match up with lows back in August and in November. But honestly, with the downgrade as well and this very ugly PMO, look at how quickly it is declining on this drop, as well as the StockCharts Technical Rank, the scooter. It's just dropped to the basement here. So I would expect lower prices. It is in the gold mining space. I had hoped that we would see some action to the upside in mining with the market in a downturn, possible bear market, in a bear market in my opinion. So I would expect it to have continued this rising trend, and it did not. So that is a little concerning. It doesn't look like it's getting ready to bounce. All right, the final one I'm going to go over is Team. Atlassian Corp was upgraded today by Morgan Stanley from a neutral to an underweight. This one, I don't think looks that bad, at least not yet. We're bouncing off of support today at $90, which was what we saw as a high at the beginning and end of December. I think we could get that bounce and actually start testing those highs back here from September, October. I'm just a little cautious, although technology has not been doing well. You can see that really the software, at least team, has been doing quite well. We've got the 50 well above the 200 and the 20. So I would expect to see a bounce here and look for a price rise to the top we had back in September, October of about 90, looks like 97.50. And that's all I had for our upgrades and downgrades. Here are just a few names that I didn't go over. The upgrades I wasn't able to go over: DocuSign, Duke Realty, WW Granger. Infosys was upgraded again today. Viacom was also upgraded. And then as far as downgrades, Albemarle, Autodesk, Edison, maybe being pulled down by its brethren, PCG, which Tom did go over. PCG actually did get 2 more downgrades after, I think, 3 that we got yesterday. So Oracle and Silica, those were all also downgraded today. And so that's all I have for that. I am going to turn it back over to you, Tom, so that we can see how to identify tops and bottoms.
Okay. All right. What I'm going to do today is I'm going to focus on some of the charts. I mean, if you're a regular watcher of Market Watchers Live, then you're probably going to be familiar with a number of these charts I'm going to show. We're in a different market today than we've been in quite some time. This is a market that's been extremely volatile. We've broken below some key price support levels that would suggest that we moved from a correction to a bear market. And so the way I approach tops and bottoms in a bear market is a lot different than the way I approach a bull market. I know Arthur Hill wrote an article, I think it was over the weekend, talking about how you have to be careful when you're in a bear market, because now instead of expecting price resistance levels to break to the upside, you're expecting them to hold, and you're expecting support levels to break instead of hold. So it's kind of a reversal to what you're looking at in a bull market. So I'm going to start by going over some of the charts that I've shown recently on the show, looking at some of the past bear markets. So let's go ahead and start with that. Okay, the first chart I have here is a chart of the S&P 500. Currently, this is where we are, and we have broken a little bit higher, so I could have changed this Fibonacci a little bit higher. We're probably up now over 11% on the S&P 500, and we have cleared 2,600, the level that Erin had mentioned earlier in the show, and that was a level that we did see back in earlier in December. I think this low came down below 2,600, but we didn't have any closes below that 2,600. And then, of course, we could go all the way back to the February and April lows, where we had established what I consider to be very significant support back at 2581 on the S&P 500. Now, what I look at when I'm looking at a bear market, I really change a lot of what I look for in terms of bottoms. Instead of necessarily looking at support, price support, which typically holds during bull markets, I look for those price support levels maybe not to be so great during a bear market. Now, I'm not going to go into it, but I have recently talked about the fact that I believe we're in a secular bull market, meaning that I think the big picture long term is higher. In fact, I think we're going to go much, much higher. But you can have bear markets, cyclical bear markets within a secular bull market. And that's what I think we're dealing with here. Now, because I think ultimately this is going to resolve to the upside in a big, big way, I do not want to try to impose my will on the market and say, listen, this market's got to go down. Therefore, I'm going to stick with my shorts, or even worse, I'm going to start adding to my shorts, because because the bigger picture, the long-term picture is higher. This could be a V bottom, and I'm not saying it is. I don't think it is, but I do think that there is the possibility, more so than maybe what we've seen in prior bear markets, or certainly the more recent bear markets back in 2007 to 2009 and 2000 to 2002, because those were part of secular bear market, that are part of a secular bear market. And so we should have expected longer periods of sideways to down action. Okay, so looking at this chart, the thing that I have on all of these charts, you'll see, is at the top I have the PPO, then I have the price action for the S&P 500, and this is all 2018, the early part of 2019. I've got the volatility index down here at the bottom, and then all the way here down at the bottom, I've got the put-call ratio. And what I've done here on the put-call ratio, and I'll show you my settings, I've gone with a 5-day moving average of the put-call ratio, because the put-call ratio every day, it just gets really, a lot of back and forth, a lot of noise. But I think over a 5-day period, you get a pretty good sense of what's going on. So down here at the bottom, the way you can set that up is under your indicators, you can put in price, the $ CPCE, that's your put-call ratio. And then under your style here, you can go with invisible. So invisible means that you're not going to see all that daily action. Instead, I have a simple moving average, 5-day. And that's what you're seeing up here, is simply the 5-day moving average. Right over here, you can see MA, 5 in parenthesis. So it's just a way to silence all of that noise back and forth and try to find some meaningful information. I mean, maybe you could, test it and go with 10 days instead of 5 days. Maybe 3 days is better. I went with 5. I think the 5 works pretty well. So I just wanted to show you how this chart is set up, because the other charts I show you as we go back in the prior bear markets, I'm going to have similar looking charts. Okay, so one of the keys, and I always say when we're in a bear market, I don't look at price support. In other words, when we break it down here at the 2581 level and we clear those prior lows to the downside, I think you have to be real careful about trying to go back onto a prior chart a year, 2 years, 4 years ago and find a support level. Because when you break a major support level like this and the volatility index shoots up, I refer to a period like this as market makers going on vacation. It's like they're matadors and they're just holding up that little, red sheet for the bull to go flying through. There's just nothing there to support the market. So when I look for, in terms of trying to spot bottoms in this kind of a market, is the extreme readings in the volatility index and the extreme readings in the put-call ratio. So if you notice, two of the big levels in 2018 was that initial push or pullback in late January into early February when we established that 2581 low. You can see the VIX shot up to 37, which historically, I don't have a long-term chart, but when you start getting VIX readings into the mid to upper 30s or into the 40s, that tends to be a really significant area. That's when the baby's going out with the bathwater, when you start getting VIX readings like that. And you can see that when these bottoms finally print, you can have massive rallies back to the upside. And missing some of these rallies can be painful, although you can see back in February when we went down, we had a rally. We ended up going back down and at least getting a double bottom before we started rallying again. Now, the problem with a volatile market is if you're off by a couple of days and trying to spot the bottom, that can cost you a lot of money. It's why I don't like to trade volatile markets, especially individual stocks. And I'm going to give you an example. This bottom that went in, and the bottom occurred, this close of 2581 was on February 9th. All right, I'm going to show you an article I wrote back on February 7th. I'll step out on that limb, the bottom is in, February 7th. And the whole reason that I was talking about it was the volatility index had shot up. There were a number of reasons. You could go back through the article, but one of the key things is the volatility index moving up. And the other thing was we had a massive reversal in the market. So reversing candle off of this downtrend. So to me, that was a level of support. We'd gone just a little bit below 2,600, rallied back to 2,700. So I thought the bottom was in. Well, it turns out that we had one more move down. I missed by 2 days the low. But, and you say, well, 2 days isn't bad. Well, if you were in, and let's say you bought at the end of the day, and I don't remember exactly what my trading positions were, but I'm pretty sure I got stopped out over the next couple of days. Here you can see the S&P 500 was back up at about 2,700 off of that reversal in early February. 2 days later, well, actually 3 days later, intraday, we were down to 2532. So we fell 168 points in the next 2.5 days after I made that bottom call. That was painful. And you might look back and say, well, you know, looking back, it would have been pretty easy just to jump in and wait. But in the moment, missing by 2 days and this big red candle right here, emotionally, that takes a huge toll on you. So if you're just off by a couple of days in trying to spot a bottom, it can be incredibly painful and very emotional in terms of trading. So that's why, again, I don't like high volatile markets. I don't like this, all the selling and the volatility that it creates, because you start getting all of this whipsaw back and forth. You think you have a bottom, and then you think, oh my gosh, here we go. Where's the next low? When you break down. And then 2 days later, we're back up. 3 days later, we were back up to 2,700 again. And it's just really difficult, really plays on your nerves. So, but when you look back, you can see the VIX did mark a very significant bottom here. When we went back in April, and I'll pull up the next article I had here. This was on April 2nd. U.S. stock slide is S&P 500 prints double bottom. It's exactly what we ended up doing. We had a nice little rally, pulled back. We still held on to that major support level and then rallied throughout the summer. Now, the next key was coming down here on December 17th and making this breakdown. And as this was actually on the 17th that morning, and I posted S&P 500 nearing significant breakdown, bull market running out of steam. And of course, it did end up breaking down. And then right on the 26th, when we hit this bottom, this one I actually did hit as far as the timing goes. I said we're nearing our first major bear market bottom. And that was on the 26th in the morning. And of course, that's where we bottomed on the 26th. So my point is, I didn't look at price support here and trying to call this bottom. And honestly, I wasn't looking for price support over here. I was using reversing candles. I was using the volatility index and those types of things to call bottoms. It was not price support from a prior low. So I think when you get into a bear market, you have to rely less on moving averages, less on price support, less on maybe individual candlesticks. I mean, you could see that one, looked like a great reversal. And then 3 days later, we were right back down below it. So that reversing candle didn't really help. Those types of things, I think you have to be careful because you're in a different market environment. Now, let's go down here to the CPCE. This is the put-call ratio. Now, the reason that this is important is you're looking at the number of equity puts and equity calls that are traded. Now, you don't know whether or not the puts are being bought or sold at the open. You just know the number of puts and the number of calls being traded. So that makes it a little bit more difficult. But the majority of traders buy puts to open and buy calls to open. It was a study I looked at years ago. I'm assuming it probably hasn't changed much. But most traders, there are some who will sell puts to open, sell calls to open, but most of them buy. Now, when they're buying puts to open, they're expecting the market's going to go lower. And the problem with most traders and most people is that we do like to tend to follow the masses. And usually the masses get it wrong because every time the stock market, you see a lot of folks piling in on one side of the trade, you have to keep in mind that you've got market makers on the other side that are going to profit from these massive reversals. So again, you're using the VIX because of the extreme reading in the VIX. That's a sentiment measure. And then also when the put call ratio gets extremely high over a period of 5 days, that is telling you that the market that traders are buying a lot of puts, believing that the market can only go in one direction, which is down. And that's usually when the market reverses and goes up. So here, and Erin talks about this a lot with her weekly sentiment, talks a lot about equity put call ratio, talks a lot about the VIX and some other sentiment indicators. And really, it's just contrarian. You have to train yourself to believe that when everybody is in on one side of the trade, that is where you need to be thinking about the other side of the trade. And as hard as it is to do, because from an emotional standpoint, market's selling off and it's literally cratering and tumbling day after day, it's really hard emotionally to say, oh, I'm going to buy and try to go against everyone. But when they do reach extremes, I think that is the key. Now, the other thing I wanted to point out on this chart, I know I'm spending a lot of time on this chart, but I think these are important concepts. I follow the history of the market, and I know that there are a lot of historical trends in play. And so I think that following historical trends also can aid you in terms of trying to identify tops and bottoms in both volatile and non-volatile markets. So bear markets and bull markets. What I've highlighted here on the S&P 500 is the annualized return by day of the calendar month. So 19th is not just the 19th of January. This is the 19th of January, February, March, April, all the way through December. All of the 19th of the month, you can see that they've produced annualized returns on the S&P 500 minus 33.44%. And this dates back to 1950. So this isn't just the 19th for the last 2 years or the last 5 years. This is going back 67, 68 years. Pretty, I would say, pretty representative sample. But the 19th, 20th, 21st, all the way through the 25th, the only positive day is the 21st. And if you look over here, the S&P 500 average annual return is 9%. So in a perfect world, what you would expect is that every day of the month would have annualized returns of 9%. But all days are not created equal in the stock market. And you can see the 19th through the 25th, all, even the plus 5% day, all of them are below the average annual return of 9%. This is the time of the month you want to be cautious if the market is doing well. And I'll point that out in just a minute. But if you think about it, 19th to the 25th, that is 7 days of every month, which is roughly 25% of the month. And think about that, 25% of all the calendar days since 1950 have produced an annualized return of minus 8.2%. That is the equivalent of about 16 years. It's over 4,000 trading days. So the equivalent of over 16 years. Imagine if I told you the S&P 500 was going to go down on average 8% a year for the next 16 years. How excited would you be to be in the market? That's the way you need to be thinking when you get into this period, 19th to the 25th. It doesn't go down every time, and I'm not trying to suggest that. But if the market has moved higher, and I'm going to show you some of these periods where we've seen rallies in the market, and notice that these rallies tend to go close to the middle of the month. And then all of a sudden we get these pullbacks. Well, 19th to the 25th does produce historically weak results. And during these rallies, what tends to happen, if you check out these rallies, what tends to happen is your put-call ratio tends to get down close to low levels, meaning now the tops mean that a lot of puts are being bought. The bottoms mean that on a relative basis, a lot of calls are being bought. Now, sometimes when a lot of calls are being bought and the market keeps going higher, you think, well, why would that be? I mean, how can the market go higher if everybody's buying calls? We should be seeing reversals. Well, I want you to keep in mind that one strategy market makers can take, if you buy a call, the market maker can buy stock and essentially sell you the call. They're buying stock, selling you the call. What is that? Covered call strategy. So as long as the market doesn't completely take off to the upside, and let's say it just goes sideways for a while, they're selling you that call. You bought the call. It's going to expire, worthless or certainly less than what you paid for it. And at the same time, they own the stock, which has just gone sideways. So anytime you see the market or the put-call ratio declining and the market moving up, just keep in mind that there's probably going to be some headwinds in the short term that's going to keep a lid on prices as we move into option expiration Friday, which is always the third Friday of the month. And what I've noticed, especially with this data down here, is that usually the week after options expire, the market tends to struggle. And I think a lot of it has to do with the option activity. So anyway, I've spent a lot of time on this chart, but I just want you to know that when you're looking for bottoms in a bear market, looking back, I mean, when I was looking here at December and I saw this prior support in a bull market, I would say, hey, let's look for a reversal. But on this breakdown, when you get that breakdown, you've got to turn your attention to these sentiment readings. Look at the VIX just exploding. And when I talked about that bottom on the 26th of December, what I mentioned was, and I'm pretty sure I put it in this article. No, I thought I put it in this article. Maybe it was in the one right after this. But what I was looking at is prior bear markets and those breakdowns. In fact, I can probably show you well, I'm going to show you the charts. I'm going to bring those charts up in just a minute. But anyway, that's what you need to be focusing on. You need to be focusing on these sentiment indicators when you're in a bear market, in my opinion, to identify bottoms. I would not necessarily be looking at prior lows going back a year or 2 years or 3 years. I think that can be a big mistake because, again, a lot of times the market acts as though, or market makers act as though they're just matadors and just letting prices go to the downside because they want to buy cheap. They're not going to try to support the market when everybody is exiting. Honestly, they don't have the resources for it. If you think about that, roughly 40% of the stock market, and again, this is a ratio or a percentage that I've seen in the past, but roughly 40% of trades in the market are based on technical analysis. I don't know if that percentage holds true, but I'm assuming it probably does. Then when a market breaks down, you've got a lot of volume on the sell side when you start to see these breakdowns. Their market makers have limited resources. They can't simply buy everybody's shares that are being sold. So when you see too much demand or too much supply versus demand, then you're going to see these types of moves, and you're going to have to wait for the volatility to tell you that you've got a bottom. Just keep in mind this 36 reading on the VIX, because that's where we were in December at the low. Let's take a look at the next chart. This is the 2008 bear market. Now, this was a secular bear market versus a cyclical, but you still have volatility. Volatility is still going to make a difference when you get these peaks. Look at the August low. Now, here we hit support as we had a very high VIX reading. This particular bottom here, we got back up over 30 in the VIX. It did mark a short-term bottom, but that was nothing significant on the chart. Here, we broke down, and on this breakdown of the prior low, again, you can't really look back to find a price support level. What you're counting on is the volatility index marking a top. And look at those long tails to the downside. Only reason you have tails is somebody's finally stepping in on the buy side. Indication market makers are at least in the near term supporting prices. We got a bounce. Notice we go back down. We put in a double bottom. The VIX again high. We bounce. But ultimately, we ended up breaking down. This, again, was that 2007, 2008, 2009 bear market. Now, this is the only other chart where we see the equity-only put-call ratio, because the other bear markets, we didn't have this data available. But once again, look at the spikes in the equity-only put-call ratio as we're getting the spikes in the VIX and as we're setting major market bottoms. You really want to pay attention to sentiment. Now, some of these blue arrows, directional lines, again, are suggesting that when you get these rallies into the middle of the month, you want to be careful because you've got low equity-only put-call readings. Again, this is the 5-day moving average, and now we're on the low side, telling us that there's some complacency. Here's the move to the upside in the market. Here's your complacency. We're into the middle of the month where we start to see the market tend to weaken anyway, and there's a nice little downtrend. Same thing here back in July of 2008. Nice rally. You can see the low here at about 0.54. That was the lowest reading of the year. So very complacent as we're making this breakout middle of the month, and then look what happens. We move back to the downside. And then these other prior moves to the upside, for the most part, also coincide with low equity-only put-call readings, the 5-day moving average. Now here, I put in this question mark because, look, we went up, but we didn't really pull back. We just kept going higher. And you have to, again, keep in mind that market makers can be buying stocks. And so if they're buying, even if they're selling calls to you and me, and they're buying the stock, they have a covered call strategy. So they are protected. And you can see here the volume picking up on these moves to the upside as well, which to me also is indicative maybe of some market makers buying on that push to the upside. All right, next bear market. Now this one I think, yeah, we didn't have the put-call ratio back then. But again, when you look at the bottoms, check out the VIX readings. Here we are in the low 30s. Now this one, and this is why, let's say the VIX gets up to 32, 34 here on this breakdown. We were just breaking down below this level, and the VIX was probably at that 32, 34 level. Had we, you want to keep your stops in play, because had we put in a buy at support here, we would have lost roughly 14% in about 3 or 4 trading days as that VIX shoots up to 44. Now 44, when you go back long term, that is a very significant bottom in the VIX, or top in the VIX, bottom in the market. The only other time that we saw anything above that level, I believe, was at the 2008, one of the 2008 lows, where we saw the VIX when we were having the financial crisis. I think the VIX on an intraday basis shot up to like 90 and then came, of course, crashing back down. But that was really extreme. But historically, when you look back long term, you get a VIX reading in the 40s, you're probably getting very, very close to a bottom. Now, one strategy might be, if you're out of the market and you're seeing that kind of weakness to the downside, perhaps think about working your way into a position. And again, I like using ETFs as opposed to individual stocks, because if the market's going down another 13 to 14%, you can only imagine what some of the aggressive stocks were probably doing in that time frame. All right, next bear market. This was 1998. And again, check out the VIX. Almost every significant bottom came with the VIX. Here was the VIX, again, extreme readings back mid-40s. So, and in 1998, by the way, we were still in a secular bull market. So you're getting extreme pessimism marking a double bottom in a secular bull market. And look at the rally that came out of that. I think we possibly could see something like this. I'm not sure. Hopefully we'll get this double bottom, maybe even go lower in 2019. But I think once it's done, I think we're going to have something similar to this. I think 2019 is going to be a big year at the end of the year, potentially. I'm still a little nervous about the first quarter. And then the final one was the 1991 cyclical bear market. I didn't put the VIX in this one. And I think the VIX was, let's just, let me put this in real quick. All right, there we go. Okay, so when you look at the bottoms on this market, again, this is another bear market. It was short-lived, but it was a bear market. Look at the VIX readings. So this support over here didn't hold. We had this double bottom. We lost it. The VIX shoots up to 36. Very similar to what we saw. And going across here, you can see major bottoms printing when we get those VIX readings at 36. All right, just a couple of charts. I don't really want to, I wanted to spend most of the time looking at these volatile markets. So let me pull up just a couple of charts. Let's take a look at some overhead resistance, price resistance, and so forth on some individual stocks. Let's see, I had a few here I wanted to go over. Let's take a look at something like Constellation Brands. So Constellation Brands clearly is in a downtrend. So when you're looking at a bear market, what I'm thinking is, on a rally on an individual stock, when I've got a PPO that's very weak, I'm going to be looking at these 20-period tests as resistance, as opposed to an uptrend when I'm looking at support. So when we're rallying, we tend to see the 20 rising 20-day holds as support. When we're downtrending, it's the exact opposite. The recent high on Constellation Brands, we got just above that 20-day before we had another shoe drop and a big gap down. So this is the kind of thing that we want to keep an eye on if we're following stocks, especially if we're shorting or we're looking for short entry. I think finding key areas of resistance is important. Next, talk about overhead price resistance. Here you can see CSX. As we move back up here and get into the 65 area, 66, maybe even up to 67, this is where we have printed some pretty important lows on CSX. I tend to use price support as one number, but I think using a range is not a bad thing. I know Arthur Hill uses a range. I think Erin, when she talks about price support resistance, a lot of times will show a range. And here you can see 64 up to maybe 67, 68 held as support on multiple occasions. We're up into that resistance area on CSX right now. Then we can pull up a stock like Johnson & Johnson, where we can see overhead resistance coming here. We broke down below 132 and then went up and tested 132. And now as we're rallying, you can see this 130, 132 area. There's a lot of things to consider in terms of resistance. So I'm going to be looking to try and identify a top, maybe with an intraday move above this key area of resistance, but a failure to hold it and it closed back down. PGR, this is Progressive Corp. If we take a look at the 1219, take a look here. Now we're coming back down. See, we've had a test of support around 62, and then on December 17th and 18th, we moved below that 62 support level. Look at the 19th. We come back up. Looks like we're going to try to make a break above that 62 area and then finish back down at the low. You really want to pay attention to these tails. When you get back, what looks like a move back through resistance, but you don't sustain it, you can't hold it, that normally is a sign that you're going to go down further. So any kind of a move here at 62, if we got a false breakout on Progressive, and then we come back down and close, say, below 62, especially below that rising 20-day moving average, I would be looking for prices to move lower. United Health, UNH, talked about this one earlier, but here is a breakout above this 250 area, now up into an area where we had prior support, 255, 260. And this is another one where if we pull up a longer-term weekly chart, we're right up against that 20-week moving average, which is at 256. We're at 255. We were down at 230 just 3 weeks ago. And now we have made a 10% move, and we're testing a very important level of resistance in terms of the 20-week moving average. The last one I wanted to show you was just American Express, AXP. You can see, again, price support here at 98, this price support at 100. We broke down on big volume, and now look at where we are struggling between 98 and 100. So as you look for tops in a bear market, this obviously would be an area to pay attention to as you get up here looking at reversing candles. Okay, so let's go ahead. I didn't really talk too much about bull markets. We've spent plenty of time throughout the years talking about bull markets. I really wanted to talk more about bear markets. And here, when you're taking a look at tops and bottoms in bear markets, I'm always looking at the VIX, always looking at the put-call ratio, because a bear market is defined by emotion. It is defined by panic. And the best ways to measure those is the volatility index and the equity-only put-call ratio. Price support, a lot of times technicals you throw right out the window when you've got a bear market. So price support resistance, remember, in a downtrend, price support doesn't hold. That's how you have a downtrend. So in a bear market, I'm paying attention much more to price resistance than I am to price support. Same thing, the moving averages. Moving average resistance, like I showed you on some of those 20-week EMAs, instead of moving average support. Reversing candles, again, I'm going to be looking more at false breakouts, topping type candles, things that happen at resistance, as opposed to trying to find a reversal at the bottom, because my strategy in a bear market is going to be more to short. In a bull market, just to recap, we can bring this slide up again. Didn't really talk too much about the bull market, but it's going to be kind of the opposite. The VIX, when you get into a bull market, the VIX sits down in low numbers. It hardly ever budges. It's very boring. I almost never use the VIX in a bull market. Equity-only put-call ratio, rarely. If you look at a bull market, you're going to see the equity-only put-call ratio stay very low. You're going to think the bull market is ended constantly based on the VIX and the put-call ratio, and it's going to give you wrong signals. Because, again, you're not trading in an emotional market, so you want to be careful using those as your primary indicators. But price support, moving averages, and reversing candles, those I am going to use extremely often, and I'm going to use them mostly from a support perspective. not resistance, because again, resistance, we're going to tend to break to the upside. Support, we're going to tend to hold. So different markets. Okay, that is it for identifying tops and bottoms. Erin, I know it is time to get into the 10 in 10. Did you have a RRG for that today?
Of course I do. I have it right here. All right, so really just the first thing, a look at the sectors that were requested. Certainly healthcare and technology, as well as discretionary, are popular today to look at for the 10 in 10. Of course, technology and discretionary both being in those aggressive sectors versus healthcare, which is more in a defensive sector. And then here is the RRG that I have for you, a couple of interesting ones. INGN I thought was interesting, ZUO. We'll probably look at those. I'm still doing my little group to figure out which one it's going to be. So let's go ahead and start with the first one, AEE.
All right, Amarin Corp, AEE. First of all, you can see it's been an uptrend. And as far as I'm concerned, it's still in the uptrend, although we want to be careful. We do have higher highs and higher lows. Here was a significant low that we pushed higher. We've gone down, we've tested that level, but we haven't broken down. Now, this could be a head and shoulder pattern. Left shoulder, neckline, head, right side of the neckline. This could be the right shoulder printing up near 67. We do have resistance. So if AEE were to move back down and break down below 63 with increasing volume, I would treat this as a head and shoulder pattern, and I'd be looking for a move maybe down another $8 or so, 71 to 63, or roughly that level. So that might take us to 55. Now, to the upside, first thing we're going to have to do is clear 67. As I mentioned earlier, when things start to roll over and you start thinking a little bit more bearishly, I start looking at the chart maybe for topping signs. So I think the possibility of putting in a right shoulder and leaving a tail up above the 20-day moving average could be a very negative sign. So today's close, if we were to struggle later today and AEE were to fall back below the 20-day on the close, that to me would be a little bit of a warning sign, especially with the overall volume trends beginning to turn a little bit more bearish as well. So keep all of that in mind, but so far it's holding. The uptrend remains in play, but I do see some warning here.
All right, let's see the next one up. The most popular in the chat room is KRE. And of course, that is the regional banking ETF.
Yeah, I think the overall market, and I pulled up a couple of charts earlier showing how we're getting up against some key areas of resistance. There have been some that have broken above, but there's still a lot of areas of the market that have got to make this breakout. They've got to get more on technical buy signals. KRE, I think, is one of those perfect examples. We broke down below that prior October low. Look at the volume picking up on that selling. And now as we're moving up, look at the volume dwindling to the downside here. So you've got a nice rally. It's been very nice, but you get rallies. You get bear market rallies. The question is, can we get through this price resistance? Can we get through the 50-day moving average? We failed there in early December. So I think now that we've rallied from 44 up to 50 and change, I think this is going to be a critical area for KRE. If we were doing turning point, I would call this a possible turning point on KRE. You really want to watch and make sure that we can break above the area. And if I was in on the long side or getting in on the long side, which I would not, but if I was, watch that 20-day moving average. If we're truly trending higher, we should not fail on that 20-day test. So watch that to the downside.
Okay, excellent. All right, this one did look good on the RRG, Zuora, ZUO, software firm.
Yeah, software's been strong or, strengthened. This one has not. So I tell you what, I'm going to bring it up on a relative ratio because a stock that, yes, it's performing pretty well, but look at what it's doing relative to its peers in software. If it's me and I'm looking for a software stock, this is not the one I'm going to get. So as far as annotating, I think this stock, I'm going to go ahead and use the annotation tool here just to remind me that this has just not been a very good performer on a relative basis. So even moves to the upside, I'm going to be a little nervous about. And consider if we are in a bear market, the market rolls over, software is going to go down. And if software goes down, you got one of the worst performers, you can imagine what's going to happen here with ZUO. So I think there, are a couple key levels. Probably the big one for me would be up at about $22 off the earlier selling. This was the reaction high before we put in new lows. I think you got to clear 22. If you do, then maybe you have a shot at those earlier highs. But for now, I'd pass.
All right, excellent. Next one I have is, let's see, Enphase Energy. It is our only energy sector request.
All right. Yeah, it's trying to make a breakout, but again, $6 is a big level. Renewable energy's been down. This is a nice performer, though, relative to the group. So let's go ahead and take a look at some key levels here. $6, if you look back, we sold. You can see the selling, the volume pick up. Each time we've rallied, here was a rally, light volume, trying to get through 6. Here was a couple of rallies, volume picked up a little bit. Here we are again, volume's okay. We need to get this breakout. I'd like to see volume come in, and I'd like to see a clear, unequivocal close above that $6, and maybe this is $6.10. I'm not sure exactly where the level is. We're sitting at $6.05 right now. The renewable energy stocks have been performing well, and this stock is one of the better performers. So as long as the group continues to do well and we get this breakout, I think ENPH is a tradable stock. But if we can't get the breakout, if we fail, and the overall group starts to go back down, then I think obviously that's going to make it more difficult to make money in ENPH.
Okay. The next one up, let's see, Coca-Cola, KO.
All right, Coca-Cola trying to get through its 20-day. Looking down here, it's been a great performer relative to its group. It's been a pretty good performer relative to the S&P. It is a little bit more defensive. So when the market was struggling, you can see Coke was outperforming into December, into the fourth quarter. But since this huge market rise, we bounced a little bit on Coke, but Coke has been an underperformer. And you can see that here in the relative ratio versus the S&P. I think for me, I need to see Coke get back through the 20-day moving average. So I'm just going to do one thing here on the annotation, and that is, just as a reminder, you can see multiple tests here of the 20-day moving average. We're testing it again. As far as price support, look at the recent low. I'd like to see that hold. For now, we're in a pretty tight trading range, though. So I think if the market weakens, I think you're going to you'll have an outperformer, a relative outperformer with Coke, but it's probably still not immune from going lower.
All right. Let's see. Crocs, KROX. Apparently, the viewer says we've broken out of a high-level consolidation, now pulling back to the 20-day EMA. What do you think?
I like it. Talked about this one. I don't remember if it was a 10 and 10 stock, but we definitely looked at this one recently. Maybe it was a breakout candidate or something like that. But here was the breakout, big volume. I think at the time I suggested wait for a pullback to test the overhead resistance level that was broken. We got that today. Also, the rising 20-day should offer up some pretty nice support. With Crocs, first of all, you've got the footwear group, which on a relative basis has been pretty strong against the S&P. Recently broke out. Crocs, great performer versus the S&P, great performer versus its peers. This is the kind of stock I want to be in. If I'm going to buy, if I want to be in on the long side, I want a stock like this that is outperforming relative to its peers in the S&P and is breaking out with good volume trends. So I like Crocs on the pullback.
All right. Let's see. How about Booking, BKNG? The viewer asks, is this still a seasonal play? You must have mentioned that at one point.
Oh, yeah. First 4 months of the year are huge bullish months for Booking. So if you wanted to take a shot, this is probably not a bad time based on seasonality. Now, again, I use seasonality to confirm what I'm seeing on the charts, and I haven't seen any kind of a breakout. So in terms of annotations, knowing the seasonality, you can see the false breakouts at the 20-day moving average. We're struggling now. I'd at least want to see a breakout above the 20 before I would pay attention to the seasonality. If we keep trending lower below the 20-day, then I don't care what's going on with the seasonality. But this is definitely one of the best stocks in terms of seasonality going back, the past 20 years. And I can pull it up quickly just to show you what I'm referring to and what the viewer is referring to and asking. But here is the last 20 years. And you can see January averages going up 5.3%, February 8.6, March 8, April 8.4, May 3.1. All of bookings gains basically comes in the first 4 or 5 months of the year. Look at the rest of the year. It basically is flat to down. So, and look at the percentage chance that these months are going to go higher. February, March, April, huge outperformance. So I think there's a lot to be said for a company that shows this kind of strong seasonality over a long period of time. So I do like BKNG, but like Insight that I showed earlier, INCY, that also had a relative, I don't want to bring it up here. That also had nice seasonal patterns, but it wasn't until we got through the 20-day that, to me, the seasonal pattern would have confirmed. So that's what I would be looking for with booking.
All right, excellent. How about Spotify? Spot.
All right, Spot, and this is number 8. Breaking above the 50, which is a good step. We have been holding the 20-day moving average, which I like. PPO getting close to the center line. I mean, it's possible we're going to reverse. If you notice, we had a very similar looking candle back at the beginning of December. Came up, broke above the 20-day, something we hadn't done for 2 months, and then right back down we went. So the only thing I would suggest is if you are trading this on this breakout above the 50-day moving average, I would really watch the 20-day moving average to the downside. It should not close back below. You can see that's been holding. Maybe you buy half in a bear market. If I was on the long side, I'd be a little careful. I'd probably buy a fraction of what I want to own, and then maybe add on the 20-day and get out if it closes below the 20-day. All right, we got another one.
Yes, I do. Okay, from the computer software and processing for our friends in Canada, GIB/A.TO. And yeah, CGI Group.
Okay, CGI Group. Clearly, resistance, I think, is pretty obvious looking at the chart. The fact that it's up near breakout territory, I think, is really good. So on a relative basis, this is going to be a really nice performer. This is another one. Volume actually started to pick up on the move above the moving averages. I think this one is range bound right now between that overhead resistance and the rising 20-day. I really like yesterday's candle where it was selling off, got close to the 20, printed a hammer, and started moving back up again. Breakout above 87 is what you want to see with increasing volume. In the meantime, you've now established price support at 84, yesterday's low, and also the moving average, 20-day moving average is at 83.70. So that's an area that I'd be looking for to hold to the downside.
All right, medical equipment industry, and this is Inogen, INGN. Reminded me of immunogen, so that's why I wanted to make it clear.
All right, good news, and I think this is our last one, but this is a nice breakout above the recent highs. So I'm just looking here over these last couple of days. But you can see there's going to be a couple of areas that we're going to have to watch going forward, especially this last one I just marked, because that's where we saw a ton of selling coming in. 156 to 160 overhead resistance. In fact, I think what I'm going to do is just move this other line to there. I think the 156, 160 area is a level I'd want to watch pretty closely. So far, we're acting bullish in the near term, rising on the, hitting that 20-day moving average and bouncing off of it. That's good. But we are going to have to, there's still going to be a lot of work to do from a longer term perspective because of all the selling that took place and all the technical breakdowns. So I think it's got a decent shot to run to 156, 160. I'd be a seller if I owned it there and see if we can get through.
All right. And you are correct. That was the last one. Here are the 10 stocks that Tom annotated today. You will find the annotations at the Market Watchers Live blog. Just go to the blogs page, click on the Market Watchers Live blog, and you will find the link at the very top, or it is in every Market Watchers recap. Time for our final market update. Let us see what the market is doing right now. And it is looking pretty good right now. Make sure this is updated properly. Here we go. Looks like we are pulling back from intraday highs right now, but you can see the Dow on a nice tear here, up 141.48 currently. And we can see S&P 500 also having a great day. We are above that 2600 level, which is the one that I've been watching very closely. But we are pulling back, like I said, down 25 points right now. Or I'm sorry, up 25 points today. NASDAQ still looking pretty good, but also pulling back slightly from intraday highs. Mid caps and small caps also enjoying a rally today, but they are pulling back. And really the one that I think is the most interesting is the Russell 2000, because we hit overhead resistance at yesterday's high over here. And we hit that, and now we are turning back down. So we'll have to keep an eye on this really closely as far as all of these indexes, because I am curious, as Tom, you mentioned, we could leave a long tail to the top. We'll have to be watching closely. Treasury yields, 10-year Treasury yields are up, reading 2.718%. The VIX, as you can see, since yesterday has been just slowly petering off here, and now we are at 18 as far as a reading, just above 18. And UUP is up, the dollar really breaking out today. And of course, that has put some heavy weight onto gold. Gold had broken out to the top here, had broken from those intraday highs we had seen before, but hit that resistance level, it looks like, on the rising trend channel. And now it is headed back down as the dollar is strengthening today. USO, big gap up, but consolidating sideways at this point. We are looking at a reading at $10.92, and TLT down, continuing its slide from Friday and making another low, but it looks like we may have found some support here at about $120 for TLT. That's all I have for the final market update. I'm going to pass it back to you, Tom.
Okay, one thing I wanted to just show on the S&P 500, because 2581 was a big resistance level. We got up above it, but it really wasn't, we weren't really pushing through. We got up to 2595, pulled back. It seemed like every time I was looking at the market over the past 3 days that that 2581, 2582, 2583 level seemed like where we were. Now today, we're actually making a break above those earlier highs. And so when I was looking at this being a bear market, what I looked at as far as the two key areas of resistance, number one was that 2581 level. And when we went a little bit above, I was like, okay, as long as we stay below that 26, I don't know what it was, 26 or 2596, 2595 level, I was okay on the short side. But once we broke through that today, I don't take a whole lot of chances on the short side, especially when I'm thinking that we are in a secular bull market. I don't want to tell the market that it has to go back down for a double bottom. I'll let the market tell me that that's what it's going to do. So we are getting a breakout. The next level, though, that I think is really important is this 20-week moving average. And I think I had that annotated. So here is that price resistance level. We're above that. But here is your 20-week moving average. And you can see the failures already the past couple of months. Once we moved below it, the PPO looks weak to me to the downside. So normally when you've got a PPO that is declining, when you move back up and test that 20 period EMA, in this case 20 week, that is normally a really tough area for the market to negotiate. So that's what I'll be looking for if we continue moving higher. That would probably be the next and last area that I will try to put on shorts. We'll see whether or not we can get through. The other thing, when you look at the NDX, you can see we are below the 20-week. We're getting closer. I could pull up the Dow. The Dow is below the 20-week moving average, getting closer. And the Russell 2000, same thing. So this is across the board. Nice strength the last few weeks. I still think we've got one more major overhead level to try to clear before I'm going to turn or even begin to think about turning more bullish on the market.
All right, excellent. Time for the scooter report. Let's go ahead and take a look at what's been going on as far as the StockCharts Technical Ranking. And I want to explain how it's used and how I use it, and also tell you how to take a look at the various groups and how to manage it yourself as far as an indicator goes. If you want to learn more about the StockCharts Technical Rank, do go to the Chart School tab and you can just search stock charts, or you can push the little, click on the magnifying glass up here in the corner, and it'll bring up the search box and just type in scooter and you will be directed right here. So this was, really the rankings come from the wisdom of John Murphy, as we say. He's the one who helped develop this. And the thing that I think is most important, and I know, Tom, we talk about it a lot regarding the StockCharts technical rank, here is the weighting and how it is determined. And the main thing that you really need to know about the StockCharts technical rank is that 90% of the calculation for the StockCharts technical rank are long-term indicators and use medium-term indicators. So 90% is weighted on the intermediate to long-term as far as the indicators go. Short-term indicators, we only use 10% when we do our StockCharts technical rank. And what it is you calculate all of this and then you determine, based on what you get, the score, then you go and you rank it among its peers. And the rankings, the different quote-unquote universes that we use are right down here. Large cap, small cap, mid cap, ETFs, and we don't use leverage ETFs or those inverses funds on any of these when we do the StockCharts technical rank. And then you can also see the Toronto and London and India exchanges. Those have their own StockCharts technical rank, so that all of those stocks are ranked among their peers. So they usually get rebalanced about every 6 months to a year. That's how we update these universes. But if there is a stock out there and a symbol that you're interested in getting a scooter for, you can request that. I can't necessarily say that it'll happen, but a lot of times if we get a lot of requests for a certain one, they can try and add that in. All right, so now that we kind of know what this is about and how it works and where to find out how it works, let's go ahead and look at it on the main homepage and what it can do for us. All right, so first of all, over here under Member Tools, we have the scooter reports here. And this will just take you right into those universes and tell you which ones have the highest ranks. And while I think this is a great way to look at the stocks, you see everything. There's a lot of entries here. So maybe there's an area you might want to concentrate on. For example, right now we know healthcare has been really strong. I think it's going to continue to show strength. And you can see if I go to the sector reports, I'm going to go do that for you. If you go to the sector summary, we also have the scooter on there. There we go. And if you look at the past, I think I was looking at the past month, 3 months, no, past 3 months. There we go. Just to see where the strength has been. And see, you can rank by the scooter, and real estate seems to be the one that is looking the best. So let's go back over to our summary for the technical ranking. Okay, so we've decided that real estate is what we want to look at. So if I just start typing real estate here in the search box, it's going to bring up all of those in that sector. And it is already listed in order by scooter rank. Now, there's various ways you can use the scooter. When I use it for my scans, and I know Greg talks about it a lot, any ranking above 75 is considered strong, and it tells you that a stock is going the right direction and has been going the right direction. Like I said, intermediate to long term is looking good. So if you're a momentum player, that's kind of a good way to go in and see. Look for those ones that are over 75, and that'll tell you. But sometimes you may want to look at some of the medium ones just because they might be on their way up. And so that's a way to do that as well. So I'm just going to look right here, and we'll look at a couple medium ones just because we're here on this report. And then I'm going to show you another way to look at these scooters. All right, so Prologis, PLD. This was on the mediums, right? For the scooter, we've got a 67.5. I like the chart. We do have the PMO buy signal. It is heading back up. It's managed, price is now managed to get above that 50-day EMA. You could probably make a case for a flag formation here. And now we got the breakout. And that tells you we should expect a move about the length of this flagpole measured from the top. And that would bring you, interestingly enough, just about up here to overhead resistance at about 67.50. So we were able to go in to the scooter, find a mid-range scooter ranking within a sector that we feel good about or that we think will continue to do well. And so this is one of the ways you can get to some of these stock symbols just to see what might be interesting to you. Let's look at a residential REIT here, Mid-America Apartments, MAA. And what's going on with this one? Well, we got the PMO buy signal just came in, and you can see the 50 is still above the 200 EMA. And with today's price action, it's turning that 50-day EMA back up, giving it a little bit of a rounded bottom here. So we've had the nice breakout above the 200 now and the 50-day EMA. We have a PMO buy signal, and we have a scooter that is improving and heading up into that hot zone. And really, if you want to look even further, you can see that the rising bottoms on the OBV, if you look at it in the thumbnail, it's even more clear, a nice bullish confirmation with those price bottoms. So MAA. Now let's go to the member dashboard, because this is another way that we can use the scooter. And if any of you have watched the show, you know that I really, really like to use candle glance. And the reason I do that is it gives me a very clear picture with my indicators on it. And that way I can really sort through very quickly what's going on. But you can also do RRG. So on your member homepage, just click on the scooters. It's going to put you right there at the large cap. You can get the top in the universe and the low 10 within that universe. And once you have those up there, let's go ahead, you can look at it via an RRG. And notice, I'm going to take this out just a little bit. Notice that the top 10 scooters just happen to be on an RRG in leading and only weakening. So you know that there is strength, and even the RRG is telling you that that's what's going on. So the scooter rankings, I think, are pretty good, and that's why I like to include them on my reports. But let's do something a little different here. Let's look at the mid caps. And we're going to look at the top up. Which ones are the big movers for the day? And you can see right now, WIT, W-I-T, is at the top. The bottom is Angie. There you go. Angie and A-N-G-I. And look, it just turned. I had it as the lowest one, and now that A-N-G-I is gone. So now we have TAL education. Well, I don't know much about these. So I just want to look at the candle glance to see if, they're showing some very good strength, relative strength today. And so I want to look at them in my candle glance, mainly because, like I said, I can look at my indicators and I can make a very quick decision on what's going on in these charts right away. All right, so these are the mid caps. So we do have a couple of, strange ones in here with very different trading than maybe the ones we're used to looking at. But I'm looking at this, and the first thing I noticed was KYOCY, Kyocera. Let's look at this. It looks like yep, there we go. Very, very low volume, very low volume. But just as a TA 101 sort of thing, let's look at rising bottoms right now here. You see rising bottoms on the PMO, rising bottoms on the scooter. And that coincides with declining bottoms on price. That tells you something good is happening. You're increasing that momentum, even though price is starting to move lower. So you know that something's building in the background, and the scooter is confirming it as well. It's just not in the hot zone just yet. All right, I'm going to look at one more, and then we will close this all out. Let's see what looks interesting. That has a breakout there. Let's look at this one, because it just had a breakout, the one that just appeared, TAL Education Group. This one, look at I'm going to annotate it real quick, and then like I said, we'll close everything out here. I am annotating the overhead resistance from these two short-term tops. And you can see right now, and if I brought this down to the last top, or even the top back here from this little pennant that we got, we're getting a breakout. We're getting a breakout above the 200-day EMA. We have a 20, 50-day EMA positive crossover. That's an intermediate term trend model buy. We have the PMO buy signal, and now a PMO moving back up in positive territory. And there you go. The scooter is confirming it. That's why I like to keep that on my chart. Momentum is great, but I'm an intermediate term trader, so I really like to look at what the scooter is doing because it gives me that idea of what to look for in the intermediate term. So we got a little breakout here. Next area of overhead resistance. Let's see. Yeah, that's probably pretty good there. About $35. And I did that. It matches up with this top back here in August, the low here in June, July, back here in April. So you can see we're getting some zones here as well, like we were talking about a top back here in January. So that would be my next look for TAL, but I think this one looks pretty good. And it is in consumer discretionary, but it's consumer discretionary is held up fairly well, honestly, considering what's been going on with the bear market. But so that's all I had for the scooter report. I'll let you know which ones were in the top 10. And then we also looked at a few symbols as we went along, just so you can get an idea of how the scooter can be used to, really look at how your stock is doing, how stocks in the universe are doing compared to what you have. It's an excellent way to do it. All right, let's finish this off. Tom, I think we need to look at that poll. We haven't looked at that yet.
Yeah, I just wanted to get a sense. We talked a lot about seasonality, or not seasonality, sentiment during my workshop earlier. And of course, you talk about it every week. So we wanted to get a sense of maybe how everyone uses the VIX and put call ratio. And 47% use it daily, 23% weekly, only 3% monthly, 18% never, and 9% not familiar. If you're not familiar with sentiment indicators, probably because you haven't listened to the show much.
Yeah, they might be new. And just come in on a Monday, and I do sentiment every Monday afternoon.
Yep. So I'm going to assume you're daily.
Yes, because you did mention the VIX, and I do look at the VIX every day. Honestly, put call ratio, some of the sentiment indicators that I show on Mondays, I don't. But you know what? Most of them only get data once a week anyway. So I figured I'd put daily in there because you had the VIX. And honestly, if I had the right X ratio is something I look at pretty regularly as well.
Well, I would say, generally speaking, in a bear market, I look at them daily. But in a bull market, I'm not going to say never, because you get into corrections, and we were in correction in 2018 prior to obviously breaking down and, in my opinion, moving into that bear market and getting past that 20% down move and so forth. But normally in a bull market, especially one where we haven't seen, all the volatility like we saw in 2018, I would never look at it. Like in 2017, I didn't pay any attention to the VIX or the equity only put call ratio. Just didn't really have that much of an impact on my trading.
Yep. I think if you're very, very short term in your trading, day trader, etc., you really do need to pay attention to the VIX, like constantly.
Yeah, I think again, in a very emotional market, I think those sentiment indicators are actually more important than our technical indicators. But when we get into a more normal market where the VIX is very low, put call ratio stays low, I think they many times can give you some conflicting information. But anyhow, there's our upcoming schedule. Just a quick update. The Dow currently up 131. The S&P 500 up 24, still trying to stay above that 2,600 level. I want to thank all of you for being with us today. Please remember to complete the survey as you exit. We'd love to get your feedback, hear what you think of Market Watchers Live. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody. We'll see you back here tomorrow. Happy trading.